This is Matt Graham with the MBS Live Market Update. Bonds extended the rally last week, although gave up most of the gains after Friday's jobs report. It was a hotly anticipated week, mostly because of the jobs report, but also because of the other big ticket economic data that arrives typically during the first week of any given month. Most of those reports were out last week. There was one report that was out the previous week, but it didn't have a massive impact. The trend has been linear and downwardly sloped for bond yields, and that continued into the first 3 days of last week with help from economic data. Monday was very quiet as far as data goes, but things picked up on Tuesday with ISM non-manufacturing and the job openings and labor turnover survey, aka JOLTS, aka job openings. This was not a report that had mattered much over the past, 10 to 15 years. And it has gained importance rapidly in the last year and a half to 2 years as the Fed has mentioned it and as markets have traded it more aggressively. And also because it has remained quite elevated relative to historical standards, even as things like non-farm payrolls have returned in line with previous ranges. So job openings were over 9 million last month, and they fell below 9 million in last week's report, 8.733 versus 9.3 forecast and 9.35 previous. That's the lowest reading in quite some time, and it helped bonds gain ground on Tuesday morning. The ISM non-manufacturing index, which is historically much more important than JOLTS, really didn't have much of an impact. Following day, ADP jobs came out weaker than expected, and Q3's labor costs also came out weaker than expected, helping bonds continue to rally into Wednesday morning. Thursday was more of a two-way day. There were gains in the morning and selling in the afternoon, perhaps with some trepidation heading into Friday's jobs report. That proved to be a good idea, considering the jobs report was at the very least respectable, and some would argue rather strong. The payrolls number itself wasn't amazingly huge, but 199 versus 180 forecast, 150K previously. Perhaps more notably, the unemployment rate, 3.7 versus 3.9 forecast and previous. And because a lot of people like to take that unemployment rate in conjunction with the labor force participation rate, that only mitigated 0.1% of the drop because of an increase in the labor force participation rate. Bonds sold off immediately on the news and stayed fairly flat for the rest of the day, with 10-year yields ending the week at 4.233. MBS still very high relative to most of the past 3 months, with 6.0 coupons around 100.5 after getting as high as 101 on Wednesday. So coming into the current week, we have replaced a few big ticket events with new big ticket events, perhaps even bigger ticket events, because we have CPI this week, the Consumer Price Index, the big inflation report that has produced a consistently huge reaction anytime it has fallen more than a tenth from forecast. In fact, many times when it's only a tenth from forecast, it produces a huge reaction. And sometimes when it comes in right in line with the forecast, it produces a huge reaction due to traders scrutinizing the internal components of the report. Those will include things like core services inflation and the housing component of core inflation, which have been sticky and not willing to come down as quickly as goods-based inflation. A day after CPI, that's on Tuesday, by the way, a day later, we get the Fed announcement. It's not interesting due to the hike or cut that won't be happening because they'll be holding rates steady. Everybody agrees on this, and it's not really up for debate. And it's not because I say so. I'm just conveying what the market sentiment is. The most important part of the Fed announcement will be the dot plot. And that is just named for the actual dot plot that it shows up in the summary of economic projections, where the Fed details each member's view of where the Fed funds rate will be at certain points in the coming years. September, recall, was a big change in the dot plot that showed the quote unquote higher for longer theme playing out in rates. And a lot of what's happened over the past 3 months would seem to indicate that that is no longer necessary. So the market is looking for the new dot plot to reflect the Fed's acquiescence of such things, something that traders think they have largely already done in speeches, but official confirmation via the dot plot will be important. After that, a couple central bank announcements in foreign countries or the European Union, which is not one country, but many, could also add to volatility in the rest of the week. And then that's really it for 2023. It will be thinly staffed and weirdly traded until the new year. That's going to do it for this week. Back to you.